All right, well, welcome. For those of you that don't know me, my name is David. I'm typically on the premium webinar side, but this is our open webinar for, I think it's quarterly. So anybody that doesn't know me, I'm a David. I live in Savannah, Georgia, via South Africa, via California. So the accent will be a little funny. Good deal, Kurt. Well, nice to see everybody. So it's an interesting time. The title of today's webinar was just developing your own process in amongst the narratives of the world. And goodness me, are there some narratives? And it's interesting because a week ago, we were hearing on CNBC and Bloomberg how there was going to be a 20% stock market correction. Did you guys get that one? And I was thinking, well, that's not what's happening in reality. And we kind of try to stay bullish on things. But unless you have some kind of empirical knowledge of things going on a rate of change basis, you could very easily get caught up in that sort of tomfoolery. Because, you know, at the moment, let me give you the narrative at the moment. At the moment, there's a lot of talk around supply chain issues, boats at the ports, how they're stacked up all over the place. There's a lot of negative out there, and absolutely it's killing the common man in the street, and that will have an effect. But this will sound callous, but we don't really care about that from a trading standpoint or an investing standpoint. What we care about is what's real and what we can make money out of, and that really does sound heartless, and it kills me what has happened. It really does kill me what's happened in the real economy, and it's very, very sad because it's I mean, so many of my friends just in general have really been hurt by this ridiculous inflation, and unfortunately it's going to continue. And we turned bullish on inflation in June of 20. We're now headed towards 2022. Anyway, you know, just to give you an idea, coal, this is just year to date, coal up 215%, natural gas 126%, heating oil 74.8%, coffee 63%, and coffee, as you know, is the life's blood as a trader. Butter up 44%, cotton 42.2%, wheat 15%. That's just year to date. And remember when people are jumping up and down about how things are going to deflate because lumber corrected. Well, lumber's up 42% in 3 months. So we have that going for us. Okay. So let's talk about I'm going to just give a brief overview of my trading process, and then we'll apply it to some markets, and I'll give you an idea of where I think things are going and how we can make money out of that moving into the future. All right. So how I like to, and those of you would have heard this before from me, and forgive me for doing that repetition, but I'm a one-trick pony pretty much. So I like to have a trading signal, and the signal often leads the economic outlook that we're going to have. All right. So we're going to do one before the other. So for me, I break the economic landscape down into 4 sections. All right. One of them is reflation. Oopsie, that R is ugly. Okay. Reflation is, this is what we're in now in my mind. Reflation is growth up. Okay. Growth up. That's a W. growth up, and inflation ripping. We're going to put INF here. Okay. Hey, Brian. Nice to see you. Welcome, everybody. All right. So reflation is one area of it. The Goldilocks area, which we'll put over here, we'll put Goldilocks, not to be confused with gold. Gold actually does go up in Goldilocks. Okay. This is growth through the roof. Okay. And inflation headed down. All right. Then over here we have stagflation. These will become relevant in a minute. Right? Stagflation. And what happens here? We have growth down and inflation up. This is what we had in Q. This is what we were trading last month, stagflation. We had growth slowing after the Delta variant. And yes, that is a narrative, but that was materially what was happening. We were seeing growth slowing. And what was interesting is that CPI number was really a stealth signal that there was going to be a new base effect for the reflation phase of Q4. Anyway, we'll come back to that. All right, so we had stagflation. So we had growth down and inflation up. And then, this is the one that everybody looks out for. And this is the one that I actually like because I think it's the right thing to do is deflation. And this is where you see the stock market crash. You see the VIX go to 38. This is growth down and inflation tanking. And what's interesting here is that this is the only part of the framework where the dollar goes up, which this is FX Street. So currencies are what we focus on. This is really the only time we see FX up, and crypto tanks here on a back-tested basis. This is where crypto goes toilet flush, which is going to make for an interesting conversation too. All right, now, how do we determine these sectors of the economy and why are they important is the question, right? So let me tell you what performs when. And this is just from backtesting, study, etc. And they change, but this is why you have the signal that leads the phase of the economy. All right. Where we at? Okay, so let me pull this up for you. Actually, I don't think that's gonna. Never mind. Right. So why are these important? Because we'll go with our little reflation here at the moment. All right. So what things do well here? Well, what are the core characteristics of a reflation phase? Is interest rates rise. Okay, interest rates rise. Yes, we had flattening of the curve last week because the two was ripping. Well, the release valve of that is the long end, the 10-year to climb, and that's exactly what happened. And so you got steepening of the curve. What's a great way to play that is something called IVOL, which is basically a steepener, and it's really the only fixed income position I have in reflation. There's lots of other fixed income stuff to have in these other, particularly deflation where rates come in. This is where you can absolutely long treasuries, etc. But shorting TLT and buying IVOL are the only fixed income positions I have in a reflation phase. All right, where you have growth steepening and inflation just ripping through the roof. All right, IVOL is a great steepener of the curve. And, you can have a 12, 13, 14% asset allocation there, and you get a nice fat dividend, and it's pretty low volatility. So it's one of those things you can go huge on dips, and it's not really going to hurt you necessarily. All right. What else does well in reflation? Small caps. Okay. Small caps, not small cops. Those are miniature police. Small caps, financials, I'll put your XLF. Tech, XLK. Things like KRE, so banks. Anything with a steepening curve, but particularly small caps, high debt to income, high beta, this stuff all does incredibly well in the reflation phase. Things that do poorly. So in other words, what would your shorts be? All right, so these are all your longs. What would your shorts be? They would be utilities and staples, XLU, and consumer staples. So in other words, the last couple of days, Sprouts, supermarkets, and Kroger supermarkets have been great shorts, even in a ripping uptrend market, just because the asset allocation relative to the stock market growth or relative to the economy is the right positioning. All right. And what's interesting here is that you guys know I like to break the VIX up into 3 regimes. Okay. And one of the investable VIX regime is sort of 12 to, we'll put it 18. And then 18 to 25 is the chop bucket. And a lot of times you'll see the VIX actually leading these economic regimes. And then the everybody gets destroyed bucket is the 26 to, we'll put 38, but it really goes beyond that. Okay, so this is the investable bucket. This is the chop bucket. And this is the deflation bucket, we'll call it. All right, now, what things do poorly or what things do well in stagflation? All right. Oh, by the way, I jump around a little bit. Gold is a short here. Why? Oh, but David, inflation's flying through the roof. Wouldn't gold be a good inflation? Gold's the worst inflation hedge going. It's a common misunderstanding that gold is an inflation hedge. It's crazy. But when rates are ripping and breaking out to the upside and we're going back into reflation, gold is a short. All right, gold is very rate sensitive and hates higher rates. It is a short right now. And silver has a little bit of contagion from gold. So if you're looking for a commodity to buy in reflation, this isn't your friend. All right, gold is a short here. However, it performs well in all these other ones. All right, now, stagflation. What does well here? Gold does well. GLD. Okay. Fixed income. I like things like high quality corporate debt, so LQD. All right. Things that do well in stagflation, that do well in reflation, tech, and industrials. Utilities do well here, which do poorly in reflation. Okay, things that equities that do poorly here because you're going to have rates falling. This is why we had stagflation last quarter. All right, we had financials, REITs, materials all doing poorly. Right now, deflation, which is everything crashes and you're going to see this VIX regime. Things that do well here, gold and the dollar. All right, so if we study things and on a rate of change basis, we're going to have, we're going from, say, stagflation to deflation, similar sets, GLD and LQD are going to do well. But if we're going from stagflation to reflation, then gold is something we're going to go from a long to a short. And our fixed income positions will be reversed. So sometimes you can keep on the same asset allocations if you've got similar sets relative to what sector of the economy we're going into. All right, things that do well in deflation is the dollar, and obviously your fixed income stuff becomes a good. Now, one of the massive shorts in stagflation is tech, because this is one of those things. Take care, Kurt. There'll be a recording, I'm sure. Sorry, I'm building the overall picture here, so it's going to take a minute. All right, so these become incredible shorts, but the dollar long is actually the one that becomes very important in deflation. Now, why is this interesting to us? Okay, now, one is that there's different allocations relative to what phase of the economy is going into, and if you get those right, you can make a tremendous amount of money. All right, but what's the easiest way to determine these things? All right, and it's rate of change, it's delta. Now, this is where things get interesting. So we just had retail sales numbers that came out. And retail sales on a year-over-year basis on a 2-year average came out at 9.89%. Just ripping. We haven't seen those sales numbers in earnings yet. All right. Now, the Case-Shiller for housing last month, all right, came out at 5.6% year-over-year growth. Well, this this is what the narratives do to one in trading. All right, is if you listen to Powell a month ago, he came on, he said, well, I've got to tell you this, inflation's just isolated to a couple things. Take used car prices, for instance. They up 20%, 26% year over year. Well, used car prices are about 2% of the CPI number. Shelter is 32%. And Case-Shiller housing prices went up 5.6%, but we've had rent mandates that have kept rent down, but owner equivalent rents, which have maintained that correlation with home prices over the last 10 years, are at 2%, and those are running off. So if rents are going to go from a 2% increase to potentially 5.6%, and shelter is 32% of the inflation number, what do we expect on a rate of change basis for inflation to be coming out in the next couple of months? It's going to rip the face off people. But it's not in the numbers yet. So we have retail sales through the roof. So our growth is going up, so we can't have stagflation. And we know our inflation data is going to surprise even to the upside. Even though the CRB index is through the roof, which is 19, we know that our inflation number is going to go up because the biggest component to inflation, which is shelter, has not been priced in yet. And we've just seen a crazy good retail sales number. So we're likely to see more inflation and good growth numbers, which came from crummy base effects because we slowed down because of Delta in Q3. And this is the crux of the message here, guys, is we have expectations in the market. I say expectations. I'm not talking about us personally. I'm saying the greater economy, the quote-unquote narrative has an expectation, right? And I like to call this a base effect. For me, that's what it is. Okay? And this is really all that matters in terms of economic projections, is what is the base effect now relative to what we're going to see. Very, very, just massively important. Because it doesn't matter, and this is what I think a lot of people miss, is that it only matters relative to what we were or relative to what we expect, because the price of the underlying asset is almost irrelevant. All right, so now our base effect because of the slowdown in Q3 was lower, and now we're going to see a ripping inflation to the upside, which gives us this inflation number, and we've seen the growth come in, which gives us this reflation, which means that rates are breaking out to the upside, and it's happening already. which gives us this asset allocation here. Okay, and we're starting to see a breakout of trend in the pound, the CAD, the Norwegian krona, or all these things with commodity related specifics for currencies. And today we just had a BOV saying they're going to raise interest rates, which is a policy shift. I doubt it, but that is the talk. All right, now what do you think is going to happen when in 2 months' time, when we're seeing 6, 7, 8% inflation and GDP massively projected up, and that's really a product of inflation, not necessarily growth. That this is the thing, this inflation masquerades as growth sometimes. But if our base effect is, for the moment, let's say 2%, and it surprises up at 5.6%, by say November, December, what do we think this sets up for late Q1 into Q2 of next year? Well, this inflation is ultimately gonna hurt the retail spender. And by the way, this reflation thing has been global. I mean, today we saw rates all over the world just tearing to the upside. But if our base effect was terribly low for this, and we know just empirically that inflation is going to rise, and then we're going to be sitting massively higher here, what is likely to happen for late Q1, Q2 of next year? Well, the reverse of this. We're likely to see a deflationary phase, even though the inflation is likely to be much higher than it was, say, a year ago. It's going to deflate relative to what it is at its highs. And that's all that matters. It's what is it going to do relative to what it is on expectations. So what do we think is going to happen Q2 of next year? We're going to see a huge deflationary push because the base effect narrative is going to be for something skyrocketing high. All right. And so then what happens to our allocation is we looking for this. Gold up, tech in the toilet, the dollar screaming to the upside. It's a career away. And maybe more importantly, crypto tanking, which is going to make a very awkward discussion. Because if you bought Ethereum at $500 and you're staring at $6,000 on your screen, it could very easily go back to 2,000. That makes for a very awkward conversation with yourself. Because here in the States, you're going to pay almost 40% short-term capital gains on that. And you're going to have potentially a 60% drawdown. I mean, huh? That makes life very tricky. All right, so I know this looks like a mess, but there's a method to the madness. All right, so I'm going to wipe that off the screen here in a minute. But I just wanted to demonstrate what base effects do, and you'll hear this word all the time. Base effects do relative to projections of the economy. All right, now let's talk about how to trade that information. So last week, so we've had this reflation thesis in mind for all of Q3, Q4, which means that small caps become very attractive. All right, and tech, shorts become utilities, etc. Now, last week we had sorry, I'm just pulling it up. Let me flash this in front of you. Okay, this is non-commercial net long positioning, or it's CFTC data. Okay. So last week, remember we expecting because of our reflation number, we're expecting the Russell and obviously commodities to rise, but also S&P, and we're expecting the VIX to drop because we're looking for more upside in the market. Okay, so last week we had the S&P here as a net short position. In other words, there were people heavily net short. All right, these are Z-scores, which are basically a reversion, a mean reversion score. In other words, 1 is what it should be all the time. 2 is effectively double its normal average on a 1-year basis. Okay, and now we have today, last week we had people net short. Now we have them almost 2 times the 1-year average net long. I mean, talk about a flip-flop. Okay, and and we have implied volatility discounts, which means that people are not buying puts on the downside. They're buying calls. This is a sign that we're a little bit towards the top. But now, as a framework, let's say later on in the week, we see this come down towards 1, and we start to get an implied volatility premium, which means that people are buying downside protection. They've actually lost interest in the upside. Let's say it goes to 20, 30% implied vol premium. That's a very, very, very bullish setup. Our macro framework then matches the net positioning in the market, or a contrary to the net positioning in the market, gives us the most amount of upside, right? So what I like to do is step 1, have a macro framework. Okay, then a short-term signal. And that can come in many ways. I like to use implied volatility. You can use pivot points, any number of different things. And then that gives you a, I like to look for higher lows and higher highs in the context of a trend on pivots, or our, range projections, which I'll elaborate on. All right, now, let's take our S&P 500. So I just showed you that the net long positioning was 2.1 on the Z-score, which is double what its normal 1-year average is. And it rallied last week into Friday on diminishing volume. So in other words, there was less and less volume into the buying at the end of the day. Okay, so, my basic principle here is this. Macro framework, that gives me my allocations. Okay. Then the signal is 1 is price, volume, and then volatility. Okay. And volatility. Okay. Now, remember our little reflation chop bucket for VIX, 15 to 22. So we at like 17 and change, I think, the last time I checked this morning. So let's say that we get to our daily R2 today on the S&P 500 is 45.03, and weekly R1 is 45.25. So the top of my range today for the S&P is 45.10. Okay. And 44.21 is daily R2. 43.26, which is quite a lot down there, is weekly M1. 43.75 is weekly S1. So for me, I have something in the region of actually 43.80 as the downside range. So if we're looking at it now at 44.68, we approximately have 2-to-1 downside, but we're still 30 points on the top of this range, and the VIX is at 17. So we're not really at extremes of this yet. But let's say hypothetically, we start to tick towards 21 on the VIX, and the S&P gets towards 43.80, and it happens on low volume, because in a bullish trend, you want, when it's dropping to your price, you want volume down, volatility up, and price down. Okay, but this is your bullish setup, and then your bearish setup would be the reverse. So in other words, if we were going to buy the S&P, anything below sort of 44.10 to 43.80 on diminishing volume, higher volatility towards the top of this range would give me the buy signal there. All right, said differently, S&P gets towards 45.10, and remember our shorts in Reflation, XLU, and consumer staples. Right, let's say we get towards 15 on the S&P on the VIX, 45.10 on the S&P 500, and it happens on decreasing volume as XLU rises. That means that the XLU will become my short, because you want dropping volatility on the buy side, and you want increasing volatility. I'm sorry, increasing, I've confused you. In our reflation, which is what we're going to see, this is our short position. So to sell this, as S&P goes towards the top of our range, we want volume decreasing as price increases towards the top of our S&P range, which gives us the short in XLU. Okay, and that's how we sort of play that. I hope this makes some sense. I've already gone super duper technical on you here, and maybe this has left you in the dust a little bit. I hope not. Price, volume, volatility. All right, now another really good way to determine what phase of the economy going into is relative performance. And this is when you can look at something like this, because the way that the market is allocating assets will also tell you where we're going. And if we look at something along these lines, financials over over the last month, almost 2%, materials almost 3%, and energy 6%. All right, this is very reflationary. And if I show you relative performance of high debt to equity and high beta stuff, you'll see that they've been doing very well too. Here, I'll show you that. This is high debt to equity values, 4.1% over the last month, and high beta 4.2%. So you'll hear people talk about the garbage trade, right? And this is what we had in March. Oh, GameStop going through the roof. AMC. We were in reflation. And we saw them just crushing it. Well, when we start to price in deflation in Q2 of next year, these are going to be the exact opposite. And there'll be a great sign to see that the market's changing, the relative allocation. So if we go back, I'm basically telling you to stay long your favorite small caps or get long your favorite small caps on this big pull down. Get long the financials, get long tech, buy energy. Natural gas is on sale today. All right, this is what we want to be in right now. Industrials and energy. Okay, but come, late Q1 into Q2, the exact opposite is likely to take place. And these will become your shorts. Short, and particularly tech. And that'll be your sign of relative diminished performance over a month, telling you that the asset allocation is changing and we're going into a deflationary phase, along with your base effects. Now, I wanted to pull up one more chart and show you why this matters too. Stand by, I'll pull this up for you. And this is maybe the most important chart of all of 2021. Okay, this is a chart of the FANGs, Facebook, Apple, Netflix, Google, Amazon. Okay. And this is from 2020 to present. And this is the NASDAQ from 1998 on a logarithmic basis to present. And if you look at this, we still, the red being the FANGs now. And what's interesting is Netflix got it back its bullish trend on higher volume ahead of the whole Squid Game thing. And now it's just going to rally on that basis. But a lot of times the signal will lead the fundamentals, which is always interesting to me. But this tells me that we have more rally, but then a huge sustained drop. And this fits in with our elevated base effect on a growth and inflation basis, coupled with a slowing down in Q1, Q2 of next year, and tech being the leader of the sell side of that. And what you'll see is volatility start to break out and tech go pretty bearish trend before anything else. And I've jumped you all over the map here. I hope I haven't lost everybody on this, but really what we're doing is a forecast. So in summary, for the next 2 to 3 months, okay, dollar down. Some of my favorites for this are pound longs, Norwegian krona, CAD. Tech up. Tech up. Small caps. This to me is the thing that's going to really outperform is small caps up. Financials up. But come towards the end of Q1, Q2 next year, all of this will be different and the dollar long will be where you want to be. Well, any questions? I know that's got very in the weeds and whatever else, but trading is complex, and sometimes trying to simplify that complex is it's difficult, but it's clear in my mind. But one tries to look at the whole picture and then allocate capital accordingly. I'm less inclined to get involved with the euro on the buy side. I prefer to wait to short that when we start to see deflation and the dollar get strong, only because the signal on France is sort of deteriorated. Germany has slid down my list of priority longs. And, we're seeing the data out of Europe is a little mixed. So in terms of trying to short the dollar, that's not the one I like. Like I said, I much prefer the pound, much prefer the Norway. Scandinavia's got beautiful numbers. And what I don't understand also lately is, we had the whole contagion narrative out of China. Do you guys remember that? Oh, Evergrande is going to kill the world. And all that was happening really is, we weren't seeing credit spreads widening. We didn't see volatility break out. Any volatility spikes were episodic and non-trending. We didn't see any data in the US start to support contagion. That was all just a nonsense narrative and a buying opportunity, basically. And if you're bearish on China, just short China. FXI is the ticker for that. If you're bearish on China, just short China, which it has been a wonderful short. Other EM markets are like, because of inflation, is Russia, Thailand, Indonesia. Shorts are like a Hong Kong and FXI China. Are there any questions, guys? Otherwise, we'll leave it there. I think I've thoroughly confused anybody. I would invite you to check out our new little website here. We have something called we call embed here, which is the market breadth advanced decline. This is something we can see relative performance every day of assets. And you can see today, this is a classic reflation day. We have utilities and consumer staples doing poorly, and you have energy, financials, and tech outperforming. And you'll see these. What's interesting is, I like to watch this because the financials goes down here on lower volume. That to me is a nice buy in this context. And you can switch between different time frames. And those of you that like to watch market gamma, we also have live gamma exposure with total strikes and historical gamma. It's all free. You can go check it out. Okay. Okay, guys. Well, I hope you got something out of this. I can be reached back at Forex David on the twit, FOREX DAVID. Otherwise, we'll see you again in the next one.